Artificial intelligence is often framed as a future problem, something that will eventually reshape finance, but the truth is it already has. The shift didn't arrive with a single announcement or disruption. It crept in quietly, embedded inside algorithms that decide who gets approved, what gets flagged, and how money moves faster than people can react. Most people think of finance as numbers and rules, but increasingly, finance is becoming a system of predictions, probabilities, and automated decisions made by machines that never sleep and never hesitate. At first, AI entered finance as a tool for efficiency. Banks used it to detect fraud faster, approve loans quicker, and manage risk more accurately. Trading firms used it to analyze markets at speeds no human could match. Credit card companies used it to identify suspicious behavior before losses occurred. On the surface, this looked like progress. Fewer errors, faster service, lower costs. But beneath that efficiency was a deeper shift. Decisions that once involved human judgment were quietly handed over to systems trained on historical data, patterns, and probabilities. And those systems do not ask whether the outcome feels fair, only whether it fits the model. This matters because finance is not neutral. It shapes access, opportunity, and stability. When AI decides who qualifies for credit, who gets better interest rates, or who is flagged as risky, it doesn't just reflect the economy, it actively reshapes it. For example, companies like Upstart, a lending platform backed by AI models, use machine learning to approve or deny loans. Upstart claims it can expand credit access by analyzing alternative data, but critics have found that its models can still reproduce biases present in historical lending. Rather than eliminate inequality, the automation sometimes updates the logic of old exclusions into new code. Similarly, big tech companies are embedding AI into the backbone of lending decisions. PayPal uses AI to evaluate transaction risk and to set credit lines for its pay-in-4 and working capital products. Users experience this as instant approval, but behind the scenes, it is a model determining not just whether you get credit, but how much, with little transparency about how those choices are made. The same goes for Square's Cash App and Apple's Apple Card, which use algorithmic scoring to determine credit limits. When individuals ask why they received lower limits than expected, the answer is often proprietary model, which means the decision is opaque rather than explained. AI has also transformed investing, especially at the institutional level. High-frequency trading firms and hedge funds now rely on machine learning models that react to market movements in milliseconds. These systems don't just respond to the market, they influence it. Firms like Two Sigma, Citadel Securities, and Renaissance Technologies have built trading strategies around AI and big data, letting algorithms buy and sell positions far faster than any human could. When thousands of algorithms chase similar signals, volatility increases, and markets move in ways that feel disconnected from underlying economic conditions. For everyday investors, this creates a growing gap between how markets behave and how they are explained. At the same time, AI has reshaped consumer finance in ways that feel helpful but carry hidden costs. Personalized financial products, targeted offers, dynamic pricing, and real-time credit decisions are all powered by AI. The same systems that recommend a song on Spotify or a video on YouTube now recommend credit cards, loans, subscriptions, and financial products tailored to individual behavior. The algorithms at Facebook, Google, and Amazon all analyze spending patterns and user behavior to target financial services ads with astonishing precision. This personalization feels convenient, but it makes spending frictionless and debt easier to accumulate. AI doesn't just respond to behavior, it nudges it, learning exactly when someone is most likely to open an offer or click a link. This is where the psychological impact becomes harder to ignore. Finance used to involve pauses. Applying for a loan took time. Spending required effort. Today, AI removes those pauses. Approval is instant. Spending is seamless. Risk is abstract. When financial decisions happen faster than reflection, people don't feel the weight of long-term consequences in the moment. AI optimizes for engagement and conversion, not financial well-being. The result is a system that quietly encourages people to move faster than their future selves can afford. Another overlooked impact of AI in finance is surveillance. Financial institutions now track far more than income and credit history. Spending patterns, location data, device behavior, transaction timing, social signals, and even typing rhythm can feed into risk models. Companies like ClearSale and count power fraud analysis by ingesting millions of data points and training AI to flag anomalies. This helps prevent theft, but it also creates a system where financial trust is constantly evaluated in the background. People don't always know why a transaction was declined or why an account was flagged. Transparency decreases as complexity increases. AI is also reshaping employment within finance itself. Roles that once required large teams, analysts, and junior staff are increasingly automated. Entry-level positions disappear first, which matters because those roles were often how people learned the system from the inside. As AI handles analysis, forecasting, and execution, fewer humans are trained to understand the mechanics beneath the surface. This concentrates power among those who design and control the systems, rather than those who operate within them. Despite all of this, AI is not inherently harmful. It can reduce fraud, improve access, and lower costs when used responsibly. For example, credit unions and smaller banks are using AI to underwrite loans for thin-file borrowers who otherwise would struggle to prove creditworthiness. Tools like Zest AI claim to help lenders make fairer decisions by incorporating non-traditional data responsibly. The problem is not intelligence, it is incentives. AI in finance reflects the priorities of the institutions deploying it. When profit, speed, and efficiency dominate, long-term stability and fairness often become secondary. The technology amplifies whatever values it is trained on. For individuals, the challenge is not to outsmart AI, but to understand how it shapes financial environments. That means recognizing that approvals, offers, and pricing are no longer neutral. It means slowing down decisions that are designed to feel effortless. It means treating convenience as a signal to pause, not proceed. Financial literacy now includes understanding algorithms, not just interest rates. AI is not replacing finance. It is becoming finance. And that shift changes who benefits, who bears risk, and how stability is defined. The future of money will not be determined by a single breakthrough, but by countless invisible decisions made by systems trained on the past and unleashed into the present. Whether that future creates more opportunity or more pressure depends less on the technology itself and more on how consciously it is used, regulated, and questioned. In a world where money moves at machine speed, the most valuable skill may no longer be optimization. It may be awareness.